ICICI Lombard reported muted earnings in the third quarter of FY22. The insurer faced multiple challenges in the quarter gone by. The claims ratio continued to rise in the health segment. Motor insurance, which is its largest segment, witnessed continued headwinds due to increased competitive intensity, chip shortages in the four-wheeler segment, and weak festive demand in the two-wheeler segment. Added to that, there's been no revision in the prevailing third-party motor tariff rates for more than 2 consecutive years now. Meanwhile, merger with Bharti AXA got reflected in the current fiscal and further weighed on the company's financial performance. Despite these issues, the non-life insurer did manage to post a profit as the underwriting loss in Q3 FY22 was offset by higher investment income. ICICI Lombard's gross direct premium income, the GDPI, stood at 13,311 crores in the first 9 months of FY22, a growth of 27% on a year-on-year basis. Given its merger with Bharti AXA General Insurance, the numbers represent that of the merged entity effective from the quarter ending June 2021. As a result, the first 9 months of FY22 numbers are not comparable with that of the previous year. Premium growth was weak adjusted for the merger. However, ICICI Lombard's GDPI growth of 27% in the first 9 months of FY22 looks good if we compare it to that of the industry, which reported a double-digit growth of 11.2% on a lower base for the similar period. This implies that the deal with Bharti AXA has helped ICICI Lombard consolidate its market position. The acquisition has aided ICICI Lombard's growth in the current times when organic growth has slowed due to various reasons. Motor insurance, which I said was the largest segment for the insurer, saw a muted growth due to overall weak demand sentiment in vehicle sales. Health insurance growth was robust last year given enhanced awareness due to the pandemic and an attitude shift of customers towards protection buying. So in Q3, growth in retail health moderated due to base effect. Low business from ICICI Bank in the retail health segment added to the headwinds. ICICI Lombard increased premium for group health policies on an average by about 15 to 20% in the previous quarter following a surge in claims and its adverse impact on loss ratio. In spite of the increase, it has been able to retain over 90% of corporate customer accounts. The underlying environment suggests that customers are now willing to pay a higher premium for better coverage, thus creating an opportunity for ICICI Lombard to grow in this segment. Commercial segments, meanwhile, like property and casualty, saw healthy growth in sync with the current economic climate. ICICI Lombard's combined ratio, which is a measure of an insurance company's profitability, increased to 111% in the first 9 months of FY22 compared to 99% during the same period last year, leading to underwriting loss. The combined ratio of below 100% indicates that the insurer is receiving more money from premiums than paying out in claims and operating expenses. Now, the combined ratio, if you look at it, is the sum of loss or claims ratio and the expense ratio. The expense ratio, if you look at it, inched by 330 basis points year on year, mainly due to the merger. Since Bharti AXA operated at a higher expense ratio, there is scope to improve operating efficiency by reducing overheads like branch cost, branding, and even marketing costs for that matter. Deterioration in loss ratio was largely driven by higher claims in the health business. There has been increased frequency in non-COVID health claims. Meanwhile, also, health inflation has been higher as seen in the 9 to 10% increase in average claim size. Investment income more than compensated for underwriting loss, leading to small profit in the 9 months of FY22. At the current market price, ICICI Lombard is trading at a pricey valuation of 7.6 times trailing book value of 9 months of FY22. However, the premium valuation will sustain given its market-leading share in a secular growth sector, fairly diversified product mix, multi-channel distribution network, solid technological prowess and strong solvency profile and healthy profitability. The stock has corrected 18% from its 52-week highs. It came under pressure as business got impacted by higher claims and slower growth. However, the company sees growth in the motor segment to improve going forward and expects a price hike from the regulator. Also, there can be operating synergies and cost savings from the merger, which may reflect from the second half of FY23. Now, following Bharti AXA deal, parent ICICI Bank stake has come down from more than 51% to 48%. This has implications as ICICI Bank will eventually have to bring the stake down to 30%. In September 2020, if you remember, the government gave ICICI Bank 3 years to comply with this regulation. The supply overhang could also weigh on the stock price in the meantime. Current weakness in the stock price due to various reasons should be used, therefore, as an opportunity by long-term investors to add the stock to their portfolio.